Welcome to vTalkInsight, Risk Sentiment Daily for December 25th, 2025. Equities are grinding to fresh highs with volatility near the lows, while gold, copper, and the AI complex all trade like it is anything but a quiet holiday week. Today we unpack how this late-cycle rally is being pulled between strong growth, powerful tech and policy support on one side, and mounting concerns over valuations, inflation, and geopolitics on the other. Across global markets, today's backdrop is best described as cautiously risk-on. The S&P 500 has posted another gain, volatility has slipped into the low teens, and both the S&P and Nasdaq are sitting on strong year-to-date returns, helped in no small part by a sharp rally in semiconductors. At the same time, record highs in precious metals and ongoing demand for safe haven currencies tell you investors are not fully relaxed about the macro or political outlook. Risk appetite is being underpinned by resilient growth data and earnings upgrades. Third quarter U.S. GDP surprised to the upside with its fastest expansion in 2 years. Consumer spending is still growing around 4 to 4.5%, and equity analysts now project double-digit earnings growth into 2026 and even 2027. AI and tech remain the leadership cluster, with semiconductor earnings expected to climb more than 60% by 2026, and pro-cyclical sectors such as banks, transports, and industrial commodities starting to participate more broadly. Yet beneath that strength, the setup looks increasingly late cycle. Forward price-to-earnings multiples on U.S. equities are well above their 10-year average, concentration in a handful of mega-caps is extreme, and margin debt has jumped roughly 40% in 6 months, even as institutional positioning is only modestly overweight. With the VIX drifting lower and trading volumes thin into year-end, markets appear to be pricing a very smooth path for policy, inflation, and geopolitics, leaving limited room for disappointment. Resilient growth and earnings upgrades are the primary engine behind today's risk-on tone. Headline U.S. GDP has printed above 4% recently, delivering the fastest quarterly expansion in 2 years and supporting the idea that the economy is still running above trend, even if underlying year-over-year growth looks closer to 2 to 2.5%. Importantly, this growth has not come solely from government support. Household spending remains robust, with estimates of 4 to 4.5% year-over-year consumption in the fourth quarter and holiday retail sales expected to rise at least 4%. On the consumer side, there are clear signs of adaptation rather than capitulation. Households are trading down and hunting for value, but restaurant sales are still trending higher and travel demand is strong, with airline bookings healthy through the holiday season and into early 2026. Jobless claims remain contained in a band of roughly 200,000 to 240,000, and unemployment is projected to stabilize around 4.5 to 4.6%, a level that looks more like a normalized labor market than a pre-recession spike. That macro backdrop is feeding directly into corporate earnings. S&P 500 earnings are up around 11% this year, with forecasts calling for over 14% growth next year and 15% in 2027, while banks could see loan growth pick up as strong nominal GDP, recently around 8%, passes through to credit demand. Equity markets remain in a clear uptrend, and pro-cyclical sectors like banks, transports, and industrial commodities are taking over more of the leadership, which historically has been consistent with a soft landing rather than a late-stage melt-up. There are, however, questions around durability. Recent growth has been heavily concentrated in AI investment and high-income consumption, and data since September point to some slowing momentum absent fresh fiscal or monetary stimulus. Restrictive trade and immigration policies, together with a fragile labor market where job creation is close to flat, mean that even a modest demand shock could tilt the narrative from soft landing towards something harder. For now, though, the balance of evidence still points to growth and earnings as a supportive force for risk assets, even if the pace is likely to moderate from here. AI and tech-led expansion remain a defining bullish driver for markets. Spending on AI infrastructure, from data centers to networking and power, has not only propelled companies like NVIDIA and AMD but also contributed meaningfully to recent U.S. GDP growth, with both political parties now treating AI as central to economic and national security strategy. Semiconductor sector earnings surged about 45% this year and are projected to climb more than 60% by 2026, underpinning strong performance in the SOX index and reinforcing the perception that chips are the new cycle leaders. The AI theme is also reshaping business models and financial infrastructure. In banking, institutions like Standard Chartered report AI-driven gains in productivity, fraud detection, and compliance, while in cybersecurity, deals such as ServiceNow's acquisition of Armis highlight a push into AI-enabled security automation. Parallel to this, tokenization and digital assets are moving into the mainstream, with tokenized equities, stablecoins used for cross-border payments, and tokenized money market funds on public blockchains all pointing to a broader tech-led modernization of capital markets. That said, the AI and tech story is no longer a one-way bullish narrative. There are rising concerns that AI investment has become speculative, with a consortium of large tech firms reportedly moving around $120 billion of AI infrastructure debt into special-purpose vehicles, echoing late 1990s patterns of over-leveraging and off-balance sheet risk. Some analysts note that AI's incremental contribution to GDP has already faded from its earlier peak, and warn that if promised productivity gains do not materialize, richly valued AI equities could face a sharp correction. The implication is that AI and tech remain both the main growth engine and a key fragility point. As leadership broadens into banks, transports, and industrial commodities, the rally looks healthier, but index-level performance is still highly sensitive to sentiment around a narrow group of mega-cap and AI beneficiaries. Investors are therefore watching for signs that AI capex is becoming overbuilt or that financing conditions tighten, because any shift from enthusiasm to skepticism in this complex could quickly transmit to broader risk sentiment. Easing policy and fiscal support hopes are another important tailwind for risk assets. While central banks continue to stress data dependence, parts of the market see room for easier monetary policy next year, with some major institutions expecting the Federal Reserve to start cutting rates in the first half as inflation drifts closer to target. There is also growing speculation that the next Fed chair could oversee a regime characterized by policy rates with a so-called two-handle, reinforcing expectations of a lower yield curve over the medium term. Politics is adding fuel to those expectations. Public comments from President Trump signal a clear preference for a dovish Fed leadership focused on reducing borrowing costs, and there is even speculation about quasi-quantitative easing programs, rebranded as quantitative freedom, aimed at pulling down long-term mortgage rates to support the housing market. At the same time, market pricing currently reflects only limited further Fed easing, leaving scope for a positive surprise if political pressure translates into a more aggressive accommodation path than is now discounted. On the fiscal side, several cushions are in play. Large tax refunds, estimated at $50 to $60 billion, are expected to support GDP in the first half of next year, while proposed tariff dividend checks and targeted measures for lower-income households in early 2026 would add to disposable income if implemented. China is also signaling a commitment to its growth target through new housing measures and tolerant currency policy, and Japan is accelerating over $500 billion of investment into U.S. projects, reinforcing a supportive global demand backdrop. However, this policy cushion is not guaranteed. U.S. Treasury officials continue to emphasize the importance of anchoring inflation at 2%, and several central banks, including those in Australia, New Zealand, and Japan, are moving in a more hawkish direction as labor markets stay tight and inflation proves sticky. That tension between market hopes for easier policy and policymakers' focus on credibility is a key fault line that could either extend the cycle if easing materializes, or trigger volatility if those hopes are dashed. Set against the bullish forces, elevated valuations and bubble risk are front and center for many investors. Forward price-to-earnings ratios for U.S. equities sit in the mid-20s, well above a 10-year average around 19, and the top 20 S&P 500 companies trade near 40 times trailing earnings and almost 30 times forward, levels that some describe as outright bubble territory. The concern is not limited to listed megacaps. Valuations across private equity, private credit, and even parts of crypto are also at record highs relative to GDP, suggesting rich pricing right across the risk spectrum. Concentration and leverage are amplifying that vulnerability. Market gains remain heavily skewed toward a narrow cohort of mega-cap and AI-related stocks, while many other blue chips, including in defensive sectors like pharmaceuticals, still trade on depressed multiples despite solid dividend yields. Household equity exposure is at multi-year highs. Margin loans have grown about 40% in half a year, and extremely low volatility suggests markets may be underestimating the risk of a sharp correction if a negative catalyst emerges. The picture is more nuanced beneath the index level. There are signs of healthier breadth, with sector and market cap rotation indicating a broadening rally and European and UK equities seeing some rotation as investors look beyond stretched US valuations. Yet small cap performance remains highly sensitive to the rate cut narrative rather than clear improvements in fundamentals, and technical signals point to limited upside for the S&P in the near term, with modest room above current levels before risk-reward turns less attractive. In this context, talk of asset bubbles is no longer fringe. Extremely low volatility at record price levels, together with rapid growth in AI-related financing and tokenization themes, raise the possibility that multiple parts of the capital structure could reprice if confidence in the growth story cracks. For portfolios, the key issue is that stretched valuations compress the margin of safety. Any disappointment on earnings, policy, or geopolitics has more scope to translate into outsized price moves than it did earlier in the cycle. Policy uncertainty and sticky inflation risks form the second major bearish cluster. Although headline inflation has cooled from its peaks, core measures such as personal consumption expenditures remain around 2.8%, and some recent consumer price readings were artificially low due to data issues linked to government shutdowns. Adjusted estimates put inflation closer to 3%, and upcoming changes to rent calculations are expected to push reported inflation higher in the coming months, complicating the case for early or aggressive rate cuts. This feeds into a heated debate over the neutral interest rate and the future Fed path. One camp argues that with nominal GDP growth running near 8% and the yield curve steep, policy is already easy, suggesting limited need for further cuts. Others focus on weakening job sentiment and pockets of labor market fragility, warning that keeping rates too high for too long could tip the economy into a harder landing, especially as restrictive trade and immigration policies add pressure. Global central banks add another layer of complexity. Authorities in Australia and New Zealand have shifted back toward a hawkish stance as core inflation holds up, and the Bank of Japan faces pressure to deliver multiple hikes with inflation around 3% and growth above trend. Analysts see potential for further upside in global long-end yields as fiscal deficits and policy shifts keep term premia elevated, raising the risk that 10- and 30-year yields stay high or even rise, even if the front end eventually eases. Overlaying all of this is rising political uncertainty around central bank independence. Policy debates over the next Fed chair, public calls for a more dovish stance, and even branding exercises like quantitative freedom highlight the possibility that monetary policy could become more explicitly aligned with political agendas. For markets, that ambiguity around the reaction function, combined with the risk of an inflation resurgence into 2026 or 2027, argues for a wider range of outcomes for both rates and risk assets than current low volatility would suggest. Safe haven flows and geopolitical tensions are the third key risk cluster. Gold, silver, and platinum are all at or near record highs, with gold reportedly above $4,500 an ounce and silver up around 150% this year, marking the strongest precious metal performance since the late 1970s. Central banks have accelerated their gold purchases, partly as a response to geopolitical risks and worries about U.S. policy, reinforcing a gradual diversification away from dollar reserves. Those flows are not occurring in a vacuum. Tensions around Venezuela, including disputes over territory and escalating sanctions on its oil revenues, raise the risk of supply disruptions, while friction between Israel and Iran over missile programs adds another layer of potential energy market volatility. Although oil markets are currently described as oversupplied, with U.S. producers unhappy but able to operate at current price levels, the geopolitical risk premium is clearly present and could spike if any of these flashpoints escalate. What stands out is that these defensive flows coexist with a risk-on environment in equities and credit. Low volatility and strong equity performance sit alongside elevated gold prices and a firm Swiss franc, while crypto performance has lagged the precious metal rally, suggesting investors prefer traditional debasement and crisis hedges. Gold's technicals now look stretched, and a consolidation would not be surprising, but the scale and persistence of safe haven demand signal that markets are quietly pricing meaningful tail risks, even as headline indices push higher. For multi-asset portfolios, persistent safe haven interest has several implications. It hints at underlying concern over policy credibility, inflation, and geopolitics that is not fully captured in equity valuations or volatility indices, and it may help explain why some investors are content to hold both risk assets and hedges simultaneously. Watching how gold, high-grade sovereign spreads, and the dollar trade relative to equities in early 2026 will be key for gauging whether today's cautious risk-on stance evolves toward greater confidence or tips back toward a more defensive regime. To wrap up, risk sentiment remains cautiously risk-on, powered by resilient growth, ongoing earnings upgrades, and a powerful AI and tech cycle, all supported by hopes that monetary and fiscal policy will ultimately lean in rather than lean against. But elevated valuations, unresolved questions around inflation and central bank credibility, and intense safe haven demand in precious metals and currencies all underline that this is a late-cycle rally with limited margin for error. As we move into the new year, the key signposts will be how quickly growth cools toward trend, whether inflation behaves through the rent reset, how long-end yields trade, and whether AI and earnings momentum broaden further or begin to stall. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.